there are some people who they'll say, well, I don't really know accounting. I go by my gut feeling. Yeah. Like they're probably lying a little bit. Their gut feeling actually probably knows accounting better than they think.
I'm Tyler Simmons. Welcome to In the Yard, a Western States podcast, where we dig into the heavy equipment industry, from the machines that move mountains to the people who put them to work. Let's explore how the world of yellow iron builds our communities for a better tomorrow. All right, well, Josh and Matt, thanks for joining me today in the Yard podcast. Much appreciated. Taking time out of your guys' busy schedule. So as we kind of get going here to kind of give our audience kind of an idea of who you guys are, can we do some quick intros?
Sure. Josh Tyree, president of Sorren now. We used to be Harris CPAs here in the Valley for over 20 years. But done a lot over the years in both kind of the tax and the financial side for a lot for construction and real estate companies.
I'm Matt. I'm partner at Sorren. Been with the firm for about 10 years now, and similar focus on construction contractors and real estate from a tax perspective.
Oh, that's kind of cool. Awesome. So Josh, how long have you been in the accounting industry or the accounting space?
From like the early 2000s. Oh, yeah, I got out of college, went into being a CPA, thought I was going to be there for just a couple of years, and then realized I kind of liked it. And I was good at it too, so that helps. But stayed in it, was not here. I grew up here in Idaho, but left, and then after 8 years, decided to move back and came back here. So, but I've been involved in the accounting industry since I got out of college. It's just been a passion of mine. I love the fact that I get to work with so many different clients and see how they're performing and how they're doing, how I can be part of that. And that's pretty inspiring for me. So it's been now almost over 25 years. So it's been a lot of fun.
Isn't it funny how life kind of does that to you? You're like, hey, I'm going to go dabble in this and try it. And the next thing you know, you're like fully psyched in. You're like, hey, I'm not sure if I'm going to like this or not. Next thing you know, it's 20 years later.
Yep, Matt, that happens.
And so Matt, what about you?
As a similar story, I actually grew up in Washington and didn't really know what I wanted to do, and then took an accounting course, and I was like, oh yeah, this makes sense. I can do this, and moved into that, and then moved down here and got into public accounting. And like Josh said, it's fun seeing all sorts of different situations. It's kind of a new challenge, new puzzle every day to work with so many different clients. That keeps it fun and engaging as much as tax can be fun.
So I appreciate what you guys do every day and how you guys solve that. And one thing that I also appreciate about accounting myself and kind of that process is the problem solving. Because every day you're trying to piece a new problem together to solve something for somebody that they might not even understand as an issue or how to get to the end of that. So thank you guys for doing that. And I can appreciate the problem solving, which is fun.
Yeah, no, I mean, it's not the most exciting part, accounting, right? Even when you're in school, I was technically an econ major, but those aren't the most exciting. Everyone wants to be an engineer or go into construction management or do those things. So it starts from when you're in school of not being the most exciting, and then it just continues on. Like tax time is never something someone's like scheduling out 6 months in advance to be on their calendar to spend time on, and like all those pieces. But at the end of the day, like it's a huge part of a business. It's a huge part of people's jobs. It's a huge part of your personal finances. Like understanding the accounting at a high level, it gives you a much better ability to do whatever your passion is. And it just happened to be our passion is accounting. But but it's amazing when you look at companies and people, and those people who are, super successthere, they do have a really good understanding of accounting.
Oh, that's an interesting perspective you're bringing up, because I was going to ask you that question. So there is a direct correlation to overall business success of a business you guys have seen in that person's understanding of their accounting and their structure.
100%. And there are some people who they'll say, well, I don't really know accounting. I go by my gut feeling. Yeah. Like they're probably lying a little bit. Their gut feeling actually probably knows accounting better than they think. And it just, there's a direct correlation between understanding your numbers, understanding where it's at, and what your success is. And it's not just the owner of the company, it's at all the different levels. Like everyone has a whole piece of what they're doing and how it ties in to the overall success. So you see that direct correlation up and down, and it's just easy. And then it's, hidden or can maybe a little diluted when everything's going good, right? When there's more work than anyone can possibly do and cash is flush, it can hide problems.
Yep.
And it's exacerbated, when there's a downturn or something goes wrong or something like that, then you really see it kind of over exaggerated too. So you see it on both sides, but those who really understand and know the numbers or the accounting and the details behind it, they end up making, whether they think it's with their gut or their mind, they make better decisions as they go through.
That's awesome. And I think too, like revenue hides a lot of sins. I mean, that's the best way to say that. Like if revenue is good and cash flow is coming in, it's really good, you can get away with a lot as manage that business. And the direct correlation of somehow connecting people's work to the financial impact and the organizational impact, the closer you can make that tie across the org, I totally agree, right? It can drive the right behaviors and drive those right decisions that needs to happen to be successful.
Right.
So let's talk a little bit about the dirt world, right? So we live in we're moving dirt every day. Our customers are moving dirt and they're doing these projects and stuff like that. So what have you guys seen in your guys' tenure? What's unique about accounting processes and practices to dirt moving and construction jobs that's maybe a little bit different than other industries like real estate or anything else kind of down that path?
Yeah, I mean, I think in the dirt world, you have a couple anomalies, even something that's a little bit different if you look at like maybe your civil compared to your generals, right? One thing construction has across the board is kind of a long project cycles, right? You're not selling a widget. It doesn't turn over every day or turn over every 30 days. It takes a long time. So the accounting for that's a little bit more complex than you normally would see. And then you have, how payments are done, how that's structured. Cash flow is a huge issue when it comes to the dirt world. And there's different pieces on that that people who are, I would say, high performers do, and others that they do an okay job, but they're not quite there. And it all relates to how they're dealing with not only these kind of long project cycles, how they're dealing with their equipment, how they're dealing with their people, and understanding the financial impacts of that.
Because when you look at like a retail business, for example, right? You're buying inventory, it comes in, you're storing that inventory, and you're selling that inventory. And when you sell that inventory and collect payment, you're generating cash.
Correct.
Right. And then you're able to manage that throughout your financials, where construction business is a little bit different, right? It can be a long project where they're making a lot of investment in people and resources and products to get to an end to then hopefully get a payment based on executing on the contract or the agreement that was made.
Right. Yeah. And it starts in construction. Like you think about the retail example you gave, right? You're technically, your contract is a 2-minute contract. The person is delivering you the good, selling it, you're getting the payment. Yep. In construction, that could be 6, 12, 2 years, plus like in thing. And so it starts from day one is the construction or the contract. Mm-hmm. So you talk about what are you doing from a bid prospect, bidding and estimating the project, because that can have huge deals. How are you setting up your contract terms on the payment cycles, right? Are you projecting out, is this a heavy self-performed job, or is this going to be a heavy, using subcontractor job? And how does that cash flow impact it as well as you go through those contracts? So there's a lot more front end work and understanding just the accounting or the numbers or the cash flow, like all of that when you start a job in the dirt world compared to say retail, just a different, and so and then as you progress through it, there's a lot of as things that could go on. Yeah. A lot of that sometimes is just solved by good hygiene, and it's amazing how that is probably the thing when times are good falls to the wayside. Timely closeouts of monthly financials, timely billing, getting your subs to submit their invoices on time, making sure you're kind of continue to do just the good general hygiene helps out a lot.
Yeah, that's interesting. And I think that kind of, when I saw a presentation from you, and I kind of want to talk through this, we were up at the AGC Summer Leadership Summit, and it really totally was super interesting to me about some of those 10, you've been able to collect like 10 themes of the biggest challenges construction companies run into that you've seen through your experience in those types of things. So remind me of what those 10 challenges were and a little bit about each one of them.
Sure. Just like 10 challenges. I mean, one comes from cash flow, right? It's just understanding the cash flow and where you are. And that there's a lot of things that go into that. Job costing, especially in the contracting world, is understanding how to job cost, what your job costing, like, for you, a lot of your customers, like how are you dealing with equipment? Are you different things like that. So job costing, understanding over and under billing. There's a lot of risk associated with that when you look at it. Change orders, monthly financial reporting, overhead, and how you manage overhead, capacity issues. That you wish you could schedule every job to start perfectly, but as you know, they seem to all start on one time, and nothing starts usually weeks from now. So then, how are you handling capacity? Credit and debt issues is another one, not only for your vendors that you're using, but then also yourself. How are you interacting with your banks? Insurance and bonding, sometimes that's not a huge piece for certain contractors. Other times it's an enormous piece of making sure they have that. And then just I would say a general lack of oversight, or oversight. And that really increases as your company gets bigger. If you're starting off and you're running a $2 million, construction business, right? One person can probably, you as the owner can have that oversight. But as you grow, you have to rely on more and more people. So how are you building in kind of that oversight of others as you continue to grow and continue to get bigger? And sometimes that's hard. Sometimes people miss that. They think they can continue to do it, but they get so busy, they're still out on a job working, and they've got 2 other jobs going, and how are you dealing with the oversight of all of that? So those were kind of our top 10 things that we just talked about when we were at the AGC.
Yeah, so the oversight one is really interesting because a lot of the customers that I interact with talk through, they're always talking about, well, how do we scale our business? How do we add more resources, more machines, more operators, right? They're very focused on doing the work, but I do think that there's a business discipline part of the scaling process that has to take place as well. So as you grow and as the organizational grows, it's making sure that you have good, clean processes in place to execute on like job costing and some of those other things, or else it just sneaks up on you. Everybody gets out of control, and then once it's out of control, you're kind of stuck, and then you're in a completely reactionary state of figuring out, okay, what do I do now, right? And that piece of it. So let's talk about cash flow for a minute, because that was the first on the list, and I'm sure you ordered them in order of importance, consciously or subconsciously. Either way. So let's talk about cash flow, because cash is king in a lot of ways. We hear that saying in the industry and those types of things. So on the cash flow perspective, what are some of the, when it's done the right way, what does it look like? What does a successful cash flow management look like?
Yeah. So successful cash flow management kind of starts with companies sitting down and projecting out where they think they're going to be next year, right? You get to maybe the end of the year, or you could do it mid-year, but like where are you going to be over the next 12 months? What is the size you want to be? Do you understand your burn rate, right? We all have overhead and some corporate costs. So like, how much are we going to spend on that? And just looking at the jobs you have in your backlog, what we're going to do, and make sure you understand where you're going. And then comparing that to where you are on your balance sheet, right? Because we all have cash sitting there. And there's some impacts when you put those two together on, do you have enough working capital? Do you have enough cash? Because working capital can include AR, but that doesn't help you pay bills yet. So it like sitting down and really looking at that kind of, it's almost like a little bit of a forecast, or you could call it a budget, but sitting there and saying, okay, what is that? And then what's my risk threshold? In Idaho, we're fairly, we're just a little more conservative here. So most of our companies like to carry more cash on their balance sheet. It just makes them more comfortable. You could do line of credit too and different things, but you've got to be prepared for kind of your cash needs as you go. If you're growing, right, you're going to have to find a way to fund that growth. And you can fund that growth through using subcontractors, kind of, it's you pay them when you get paid. So that's one thing. But let's say you're on the dirt side and you're heavy self-perform contractor, you're paying payroll and some of that equipment and all the materials going into it. You don't get to not pay them until you get paid from your customer. So you have to front those costs. So making sure you understand what kind of business you are in and what your cash flow needs are. And companies who know that, I'll go into ones that are really successful and they know for next year I need to have X amount of cash sitting on my balance sheet at all times. So I don't take distributions when I don't need to take distributions, or, I really effectively go out and collect. I don't just let my AR sit there for my customers. I'm active in collecting that, or I'm structuring my contracts to allow myself to be able to bill sooner than maybe I would normally bill, right? Those are all things that happen. And then understanding who your customers are, right? It's taking that general understanding of your business and where you want to go, and then matching it up with where you need your cash to come through. So
Yeah, and it sounds like it could be pretty simple or very complex, right? Like simple from day one, and just like as you were talking through what it could look like. Simple from day one is you open up a notepad and you write, this is what I think my revenue is going to be next year. Here's what I think the costs are going to be to do that, right? So you understand the cost to get what you need to be done, right? You understand really quick, how much cash do I have? And you can really, and what is my burn rate? And pretty quickly you can get to this piece of it. Do I have enough cash flow to manage the growth I'm going to see? Right. And then if you don't, well, then you start making some decisions on how to get there. That's when you really start peeling back and looking at your receivables. Okay, who hasn't paid me and who do I need to get money from? Right. To put some more money in the bank, and those types of things are where's my lack in my billing? Am I not billing stuff soon enough to get through that piece of it, to get that AR in there? So it can be a very simple process just on a notepad, or a very complex process, I'm assuming, for a large organization that's automated and has all the fancy tools of everything.
Yep. Yeah, it could go both ways. I think another example of just businesses that understand the cash is, the last couple of years, and we share a lot of clients together. Clients are looking at equipment purchases, especially towards the end of the year. I know we'll get to depreciation and everything later, but they're looking at equipment purchases, and interest rates have been pretty high. So the desire is to pay for it up front, right? They don't want to carry the interest cost. But you have to mash that up with, okay, well, what's your cash needs next year? Because there is a cost to that, but you also need cash to continue on. So you can't just spend all your cash to save on interest. You've got to balance it with how much cash do you need? Maybe it actually makes more sense and is easier to just finance your equipment than it is necessarily to go out and try and get a separate bank loan or do something like that. And then so it's a balance every year, almost on all of our clients. Not that they're not going to buy equipment. They generally are always going to buy equipment because they don't want maniacs. But it's okay. How much do we want to finance? How much do we need to keep in the in the bank account? It's a kind of a cash flow question that we're leading them down as they start the next year.
And I mean, in a heavy equipment business, right? And this is kind of on the job costing conversation, how to lead me into that too. When you look at different businesses and stuff like that, and you look at companies that have big dozers, have these large machines, is that pretty asset financial heavy for them? And when you look at their businesses and their operating costs and their cost of their business, is that big equipment pretty high overall?
Yes. I mean, it is. It's a huge asset on their books. I always tell them that you treat them like people. Like that loader is just like a person.
Yep.
Right. You charge your person to the job. You need to charge the loader to the job. You want to make money, right? Like if you're hiring someone, you want them to help you, make money. Same as your equipment. I just tell them, treat them like people. There's maintenance requirements on both. You got to take care of also of, yeah. Right? And the ones that look at it that way and treat them both that way are generally way more successful. They definitely see the return on that. So, but they're very, very similar.
Yeah, on the job costing piece of it, and we can kind of go down to that one, because I do believe our job costing is also another big part of successful businesses, right? Because just like anything else, you're going to bid the job for a certain amount. You need to know midway through that job, is this going to work or not? Right. And the closer you can get to a mine alignment or not, the quicker you can make a decision. Right. Is my assumption from what I'm looking at here. So let's talk a little bit about the job costing, Kate. What have you seen works the best, and what is the most positive or best practices around job costing you see?
Yeah, I mean, kind of the nature when you're small, they're probably not the best at job costing, right? But they have the ability to have the oversight, which is I think number 10 on the list, but they're able to control their jobs. And generally when you're small, you're working on all of your jobs. So you really have a lot of control with not only salary, but then also that. As you get bigger though, you lose that. So then job costing becomes exponentially important. that you are costing all the pieces to your job, that you're costing not only your equipment, but then all the other expenses that come through as well. And what that gives you from a uh, owner standpoint is the ability to make changes, to be able to understand where things need to go out, or if there's an out of scope item, or if you need to go back to the customer and talk to them. Like it's much easier to do that midstream than it is to do it at the end. And it's much easier to address any issues that come up as you go through that. So, job costing is kind of the very first part. If you do not have your costs in the right spot in your accounting system and you're not costing them correctly, even the overhead, like that, probably the largest contractors out there start to even cost out their overhead. So they're pushing that overhead into their jobs to make sure they're covering that. But if you don't have the actual job costing, then there's about 4 other things on this list that go to the wayside. Because you can't look at your over unders and really have it be accurate. You can't look at your financial reports. Like none of it really gives you the information you want if you don't start from square one and cost all your put all your costs to the right job.
Yeah, and I think that in what's interesting about the job costing thing too, and you were talking about heavy equipment and the cost a business has to heavy equipment there a little bit, is like we try to provide customers with more than just one way to get equipment from us to fit their financial needs. Right? Like we sell heavy equipment, you can come out and buy it and finance it, and we talk through some of those a little bit as well. We do also offer some lease programs and some other pieces of that, so that's going to have a different financial impact to our organization. And then we also offer rental, right? Because there is a point in the decision point when a company is, if they're very clear on job costing and their timeline, they can add another asset to their fleet really quick. Yeah, it might be higher cost if you look at it, but the flexibility of it to all of a sudden come off their books also is a big benefit to that as well, as they look through that piece of it. So that rental assets in there as well from the job costing, whatever they need to do perspective. And so let's, on the job costing piece of that, we talked through some of the strategy and some of the pieces of that. What are some of the tactical tools that you see people use to job cost effectively? Do they have an Excel spreadsheet that they're using, like that they're tracking that to? Do they have like a software that they purchase that allows them to do that? Like how can a guy that's never job costed, what advice would you have for them to get started in that?
Cool. That's a good question. So we'll just say like 90% of businesses probably in this valley are using QuickBooks. Okay. Like it just happened across the country. Like it just is, that is your standard. And there's some limitations to QuickBooks. It's user friendly and easy for those who are getting into it. But when you're at that stage, it is really just making sure all of your direct costs are getting there, right? You're probably doing some of the more advanced job costs on the side, whether it's through an Excel spreadsheet or something like that. But just starting to get, I don't know how many QuickBooks files we'll see with all the jobs and then what's called a shop job. And the shop job is the biggest job in the QuickBooks file because it has just all the costs. They don't want a job cost sitting there. And so like try to get the shop job like as minimal as possible, almost nothing, truly just shop costs, and then everything else costs out the job. That would just be like step one. Generally speaking, as contractors get bigger, they have to migrate to a more sophisticated software, and there's not going to endorse one right there, but there's several on there. But generally what that software will really allow you to do, or there's some add-ons to QuickBooks as well, some tools that if you want to stay with QuickBooks. But there's some more sophisticated software, more designed specifically for the construction community that allows you to start to do equipment costing, to start to do payroll cost, overhead and all that kind of stuff with your payroll, and it allows you to start to layer that into your job reports. At the same time you go there, though, you've got to be of a certain size. You've got to get bigger because there's generally speaking going to be someone that you're going to have to hire to help you run it, right? These softwares are great, but they're only as good as what goes in. So it's, do you have someone managing it? Do you have someone who's actually taking the contracts and the bids and the schedule values and putting it into the software so that you could actually use it? Are you, so are you managing and maintaining the system? So we'll see that. I would probably say contractors, they go north of kind of an annual run of somewhere in the $15 to $30 million range, they're kind of stepping up their software. And then if you get even bigger than that, you kind of step up again because you just add complexity as you continue to grow, divisions, different pieces. Sometimes acquiring different companies, it just adds that complexity. But where we see the pitfalls or the mistakes is contractor that outgrows where they are, but they don't want to invest in software or the people to help manage that. And then all of a sudden you find out you have a job that's a massive lost job or something went wrong and you didn't catch it. So it's really in the job costing piece, like the database is maintaining the database and making sure it's up to date and the right size for your company is important.
Yeah, it's interesting. Like, there's so many ways to solve that problem, right? And I respect and not endorsing us a software oleo because there's a million of them out there. But I really appreciate is kind of the plan you talked through there a little bit. Like, start with your basic accounting software, which is very common for QuickBooks, and just get rid of the shop job. Figure out how to get those costs, and it might be called something different, but if somebody's listening today and they want to know what they need to do today, start by looking at the shop job and figuring out how to get that allocated out. Right, that's step number one to get job costing. Right?
We'll see we have some clients and they're great clients. So but they crack me up. They come in and they're like, oh, our margins on our job are 45%. I'm like, guys, no way. Yeah. So we go through, we're helping them put their comp schedules together. We come back and it's like, oh, actually they're like 15%.
No, yes, afford it.
After we allocate, I mean, you're still profitable, but then what happens, all of a sudden you have a job go wrong or you have something like that. And they all I add the conversation, well, this job actually you lost money on and they don't know, because they didn't allocate all the costs to it. And so then it's like, well, let's not do this job over again. Let's say no to this or increase the pricing. So it does bleed in. Job costing will bleed into everything that the large job.
Yeah, I think it's just that knowledge of the over and the under as it's happening is huge.
Right.
And because then you can make decisions as it's what's going on and you're not waiting until the end of the, I cringe a little bit when I'm talking to some customer and they call up and they're like, it's December. We need to buy a machine right now. That should have been planned a long time ago. If you were aware of what was going on, right? It's just an indicator of I understand there's some stuff that comes up or billing stuff that happens. Totally get it. But an equipment purchase and the financial decision of we're investing in our business, should be a very educated and very prescriptive process, especially if you have good cash flow planning like we talk and we have good job costing. You should pretty well know the steps you're going to take a month or two ahead to understand this is what we're going to do to grow a business.
Right. Is that a fair assumption or a fair thought process? That's a very, very fair assumption. Our great clients come in with not should I buy equipment or not? They have a whole list of equipment that they need for their business. It makes great business sense for them to have the equipment. They're ready for it. They're basically asking us to help bridge that last little bit, the cash flow piece, the double check. And, at what level, do I buy all 7 pieces or do I buy, 5 or where do I go? And so that's much better than, those that are living by their bank account and generally especially in this industry, you'll see December, January slow down a little bit because of the weather. But you're collecting on all your AR and then they see their bank account balloon up and they have all this cash and they're like, ooh, well, that means I'm gonna pay tax. So I better go buy equipment. Well, it's not the good way. Red flag. Yeah. So it's just being a little bit more thoughtful and planning out and I understand at every stage, right? When you're starting your own construction company, you are living by your bank account and you're working, you're doing 10 different jobs. But as you continue to grow as a company, you have to continue to kind of evolve. So,
yeah. And I think the scaling piece of that and what I appreciate, Josh, you're talking about is get the cash flow thing right, get the job costing thing right. Because those are probably the two most important. If you don't get those two done, you're going to have a hard time long-term growing your business and managing your business. So, right. Into doing that the right way. So that's super helps. Out of that list, what's the other, what would you say was the other main one that a company really needs to focus on for success?
I think as you grow, right, as you're growing, to me, capacity constraint or capacity planning has always been a big thing. And that's mostly for contractors who are on a growth, kind of more of a growth strategy. because you're just going to be funding your growth. So it's going to require extra cash flow. It's going to be, require all that stuff. And then on the other part of capacity is it's really hard to know when exactly, like why cash forecasting is so hard in the construction when you're a small to medium sized contractor is because of you don't have total control over when all your jobs are going to start, right? And that initial flux. So just making sure they're really good at kind of capacity planning, understanding where they need their crews, where they need their equipment, how they're going to fund that, because it's going to be at best a 65-day lag before you actually get cash. Making sure you have a very sound financial oversight kind of process. This is what we're going to do. Here's how we're going to close. Here's what we're going to look at. Here are the reports. Understanding what the reports tell you. Over unders can tell you. That's like where all of your if you're getting a monthly job schedule and you look at your over unders, you can find a ton of risk inside your company. Like it will highlight things that are trying to be hidden. And sometimes it's good. Sometimes it's profit that's being hidden, and they're carrying it to the end, and they want their big bonus at the end, which is great. Like we never complain about that. But then there's a lot of risk, like losses and problems and jobs that are in those numbers. And so really having that sound thing would probably be where I'd group all the rest of those items kind of into, and just making sure you have a really sound and timely process.
And I think that does relate too, also to, as a construction company, as you're bidding work and you're getting these contracts and you're doing them, making sure that it's very clear on how you're going to invoice and how you can invoice throughout the project and opening that up. I think that oftentimes, as a business, it's like you want to take care of the customer, you want to do what's right. So I'll bill you at the end, right? And you're just trying to do the good thing, right? I'm taking care of you. I'll bill you at the end. We'll get all the costs up. And the customer service is a big part of the process, right? For a business that's growing. But also that can introduce a lot of risk in that same thought process because the business is investing a lot into it. And then at the end of it, if the customer says, yeah, I appreciate that, I'll pay you in 60 days. If it was a 60-day project and then they're paying you in 60, you're 120 days from when you started the project and made your first investment in doing that work before getting paid to get that done. Right? And if you wouldn't have job costed correctly throughout it, who knows the actual impact that's going to have to your books as you go forward from there. So I think that oversight in structuring those contracts in a manner, or the agreements, contracts is sometimes just a handshake agreement, depending on if you're small, of like, hey, I'm going to invoice you here, here, and here. And just having those open conversations up front to make sure you take care of your business health, right, is a big key to success, right? As if not, you're going to get yourself in a bad spot as you work through that.
You are, and you get yourself in a bad spot on a job, even when times are good. And it's amazing when you look at how much that took away for the year. Like you could have 10 great jobs and one bad job, and it could wipe a ton of it away. Mm-hmm. But then also, we've all lived through a recession. There'll be multiple recessions, and everyone takes a hit during a recession. But you don't want to take that like disastrous hit where you're out of business. Mm-hmm. And so just making sure you're prepared for when that happens, because if we could all tell when that was going to happen, we'd all be retired. So we don't really know for sure. So it's just being prepared so that you can adjust and work your way through and then come out on the other side, very successful. And we have a ton of examples in this valley of contractors who did a phenomenal job. In the last one, we work with a lot of them. So they're constantly looking and setting up processes for that. But part of that too is you just got to make time. Like you don't know when it's going to come. You just have to be able to make timely decisions so you can react quickly. And that's just a recession or a bad job. It's the same. It's the same concept. Right. And what's interesting, just correlating this in my head, if back to closing the month thing 6 months later just stresses me out for other reasons. But just even thinking about that, like if you're not closing the month consistently, so you know where you're at and you're closing 6 months out, that puts you at a massive risk for a job that's going wrong because you don't even know where you're actually at. Right. And so you go to 6 months later and it could be way worse or way better, and way better sometimes not even that good either, right? Because you have a plan to manage that. You don't have a plan, or you don't have a process or a tax strategy to manage that as you go through that. It could have a negative impact as well. Right. So it doesn't matter if it's good or bad. You got to kind of know where you're at right through that process. So
let's talk a little bit about closing the month every single month, because I think that that's an important thing that has to somewhat get defined for a business. So what are some of the best practices you see in a construction company? What does it mean to close the month, high level? And then what are some of the best practices you've seen at that?
So we're going to vary again, depending on size. First thing I would say, smaller contractors, if you're running jobs and out there and you're an owner and you're running the jobs and maybe you're the super and the whole thing and then you're also trying to do the bookkeeping on the weekends, doesn't work. You'll always pick the job before the accounting.
Absolutely.
You'll always end up behind.
Or the family time, or
Right.
out on the lake, or
exactly.
whatever it is. We're all humans.
Right. So step one is just making sure you have talented people. It could be just one, or it could be a contractor. It could be someone, but to have someone talented that can help you do it, right? Not trying to do it as a side job, because that happens a lot. And then as you get bigger and more complex, it's understanding the checklist, who's doing what days they're going to be done by. So are you going to be, are you going to cut off your subs on the 20th and you're going to bill on the 25th? So by the 31st, you can, finish out your payroll and close your books, on the 10th of the month or whatever. And then what are the financial reports? So defining exactly what reports you're going to look at every month: balance sheet, income statement. If there's a cash flow, great. If not, that's not always common because they're fairly complicated to put together. And so usually it's balance sheet, income statement, job schedules, and then there's generally maybe AP and AR report. And then really it kind of depends on the contractor. There usually is like one or two other reports that are very specific to that construction company and how they operate, but they're consistent. So it's the same consistent reporting package every single month. And then on top of all of that, the people looking at it actually look at it
And know what they're looking at.
and do it. So generally speaking, it starts at the kind of the executive or owner level and they do it. As you get bigger though, it's doing some training down to people who've come up through your system and started maybe in the field and now they're a PM, right? And it's the same with our job, our CPA world. We start typing in tax returns by the time you get to be where Matt is. Like, you're now a business owner, you got to understand like the financial training. Well, where did you train them to know what to look for or how to do it? So the really successful ones not only have a really tight close process, a defined reporting package, everyone knows their responsibility, but then they also have they've taken the time to train those that are coming through the system to understand what it is due. So
Yeah. You highlighted one too that I think is also really the balance sheet. I think it's overlooked quite a bit, and just kind of looking at balance sheet and where life is actually at. Right? Is it going up or down? Or are we moving in the right direction or not? Because that's a really good look at a business help.
if you look at your income statement, it could say, oh, I made $1 million this month.
Yeah.
Right. And then you look at your balance sheet and your AR just went up like dramatically and you have your cash went down.
Yep.
It's like, well, I hope those receivables are going to be paid. Like, is there there's a lot of risk inside your balance sheet.
Yeah.
And so let's, plus this is the dork in me, like an income statement without a balance sheet doesn't, like, the two always have to reconcile so you can actually make sure your reports are accurate.
Yep.
By looking at both. If you just look at one or the other,
Yeah.
it could be totally wrong. So by having that, it's a double entry thing we call in accounting. It's debits and credits always have to equal, or if you have a balance sheet and income statement, at least your reports are accurate.
Yeah. I remember a very funny life lesson from Kelly when we were working through all this stuff. I was doing some homework for an accounting class, and I said, Kelly, can you take a look at this? And she goes, this is wrong. And I'm like, what do you mean this is wrong? And she goes, if your income statement you wrote in your balance sheet don't equal. And if those don't equal, it's all false. And she was that locked and lied about it. She's like, go do it again. And so it was absolutely great going through all those classes and having a CPA sitting there telling me, your homework's wrong. Oh, thank you so much. So I can totally appreciate that those have to match to go forward from there. So, well, let's segue a little bit into the big, beautiful bill and some of the tax stuff, right? Because that's been a hot topic this year is just a lot of things that happened because it's got very polarizing politically. But let's just make sure we stay tactical in the facts of what it is and how it can be applied to a business, right? Because like there is some beneficial things in there that I think that came through. So
Yeah.
but the big beautiful bill was like 800 and something pages, I think, is what it was. But from your perspective to a construction business, what are some of the impacts to a construction business from an accounting perspective that came out of that?
Sure. Yeah, and some of this kind of gets lost in that is a huge bill. It wasn't just a tax bill. They had so much, like that was kind of the plan. They had so much that he wanted to just get passed in one bill. So we focus on narrowing it down just the tax stuff. And from a taxpayer perspective, the majority of the stuff in the bill very taxpayer friendly. And the biggest thing that helps out taxpayers is that they extended a lot of the provisions that were in Trump's first tax bill back in 2017, the Tax Cuts and Jobs Act. One of the biggest things in there is that the 20% qualified business income deduction for businesses that operate as pass-through entities. So that's S corporations, partnerships, sole proprietorships, anything that's not a full-fledged C corporation. You get basically a 20% deduction on your net income from your business. Huge tax savings that was going away if not for this for the big beautiful bill. So they extended that permanently.
I think that too, to add to that, I think what some people don't realize is if this bill had not passed, most of this stuff would have fallen off at the end of this year.
Yeah.
So our taxes would have gone up dramatically if some of these provisions that we've had for several years did not get passed. And not only that, a lot of them were made permanent.
Yeah.
Which is good. So it would actually, they're not going to fall off again. They're going to stay permanent until they pass another tax law or something like that. But that was a huge impact. Probably 90+% of our contractors are pass-through entities. Like only a few of them are actually corporations, C corporations. So this was a massive impact.
That's 20% that would have just got added back into a business right there in that one piece of it that they had potentially never thought of because of when they came into business and those types of things. They could have had a huge impact, like you're saying. So that's a huge win.
And I was reading something that if they hadn't passed or extended some of these things, it would have been the biggest tax hike in like U.S. history. Just all of those provisions falling off. So very, very beneficial for taxpayers that stuff got extended, and not just extended, but permanently. So it makes it easier for tax planning when we know, save for them passing another piece of tax legislation, which, always could happen, but we know that it's not just going to fall off in the next 5 years.
And even like they could pass more legislation, but usually, at least in the last 10+ years, tax legislation has been driven because there's some rule that's falling off. So they're forced to come to the table and negotiate and make a decision. Well, now with a lot of these being permanent, there's like, not that they couldn't in the future, but there's not a impending date that they know that they're going to have to do something by.
It is great for stability in tax planning, and so that's a big thing. The other part that I think, especially for the construction industry, were the provisions that were extended around expensing capital purchases like equipment. And like we were talking before, a lot of contractors very heavy in equipment. They expanded. There's two kind of equipment expensing provisions that got updated and expanded. The first is Section 179, where it allows you to expense in the year of purchase up to a certain amount of capital purchases, where if you didn't have that, you would have to break it up and depreciate it over the life of the asset. And so it just brings that deduction into the year of purchase, helps you save on tax in the year that you actually buy the asset, which can be very helpful for cash flow. You're not expending all this cash to buy the equipment, and then on top of that, you don't get a commensurate deduction for it, and you're paying tax on it.
So in theory, right? Because every business is going to be different, right? And every piece of advice would be different of how you work through this. But in theory, a company could go finance a new piece of equipment, job cost it over the course of 5 years from a business job costing perspective, but basically
do all the bonus depreciation from a tax perspective this year.
Yes. Yeah. Yeah. And so it doesn't even have to line up with the cash expended. If you finance a piece of equipment, you can take the cost of the equipment as a deduction. It's not linked to the cash expended. So Section 179, we like that in Idaho because Idaho also allows that. The other provision is bonus depreciation, which is essentially the same thing, except that Idaho doesn't allow it. So you have a little bit of an add back there for state tax purposes. But before the bill, bonus depreciation was ratcheting down. You could only take like 60% in 2024, and it was going to go down to 40%. They bumped it back up to 100% for 2025 and going forward. And that's another permanent provision in the bill.
So if for a construction company to take on that depreciation and both of those types of piece of it, what direction or guidance do you typically give a construction business to maximize those deductions?
Sure.
What can they do to maximize that?
Yeah. The first thing, and I have these conversations with our clients when we're doing tax planning at the end of the year, is like the first thing that you want to do is not let the tax tail wag the business dog. Like you were saying, you shouldn't go out and buy a piece of equipment just to get a tax deduction, because it's not a one-to-one thing. You're spending cash to lower your tax liability. It's not on a one-to-one basis. So it depends on what your tax rate is. You could be spending $100,000 to get, a $32,000 tax deduction. And so first you need to make sure that you actually need the equipment. That's what I said. Yeah.
The one of the top 10.
Yeah, I think it's interesting though. That's where you really are looking out in the future. It's not, do I need the equipment today? It's what equipment am I going to need next year? Like I should know. A lot of our contractors know what jobs they have on deck for next year and where they're going, and they'll be able to tell you pretty quickly. I need this loader. Or I need this. Whatever it is, and it's like, okay, well, if you need it and you're going to need it and you buy it now, right? We'll save the 32% on it now, and you're going to need it. That's a great decision. Just because you want a new truck, just kind of a personal choice. And but if you had a great year, then go for it. Do whatever you want.
Yeah. So, but just realize that you're never going to generate like a true like savings by trying to get a tax deduction, right? It's always a marginal savings on. If it's a needed business purchase, then we can plan on like, all right, let's do it this year because we have taxable income to offset, rather than next year where we we want to accelerate deductions to get more cash in your pocket now because of the time value of money. And that's kind of just the game in taxes, accelerate deductions, push off income as much as we can.
Yep. And I think it makes total sense. Just kind of highlighting on it, like, we talked about cash flow planning, talked through job costing, we talked through, basic capacity and what you've got planned in the books. If you can make sense of those and you need to buy assets this year that you're going to need next year, it makes sense to do that, capitalize on those deductions for sure. And there's some really good strategies that can be put in place to get that done. Yeah. And I appreciate kind of your perspective there is don't let the tax tail wag the dog. Right? Because I think that's oftentimes, I think it's easy to fall into that a little bit of saying, hey, I don't want to pay any taxes at all because it's the government, right? And so then all of a sudden you're making bad business decisions because you don't want to pay the tax, which is hard. I mean, that's somewhat can become an emotional decision, right? And then puts you in a bad spot as you move forward from there. So I appreciate that. I inspect it.
Bonus depreciation, tax depreciation. It's not if you're going to pay the tax, it's when you're going to pay the tax. Yeah. Right. So people need to understand that there's one way to avoid paying taxes. That's death. You don't want to do that.
Even then they get you with the state tax. Right. So
and then the other thing I always try and remind people, like paying tax means you're making money. Like they don't tax people who have losses. Right? Like that's not there. So like it is there is a point here. We are at a fairly, just personally, this is a personal opinion now, with this act going through, at a fairly low tax rate across the board. Like if you just look historically over America's history, at least in the last 50 years, fairly low, maybe even the lowest. Don't quote me on that. Tax rates for us. So it's not a bad place. You look at where we sit from a debt perspective, where, how costs are rising, all that kind of stuff. Like there's eventually something that's going to have to happen there to pay for it all, right? And tax revenue, and there's tons of different tax ways to do it. It comes up. So there is some point is as you're making money and paying tax, you are generating personal net worth, right? Post after tax. So there's a delicate balance between not paying any tax and deferring everything. And then we also see it with equipment. How much debt are you taking, right, on it? And that balance, because if you don't pay any tax now, you take, and it's all 100% financed, for the next 4 years, you're going to be paying the debt with no write-off associated with the cash. I've seen companies have losses in a year where they owe tax because they have zero depreciation left, right? So their book, like what they're giving their bonding company and stuff, has a loss, but their tax return has a big gain, and they have a tax, big tax due. So you just have to keep it all in balance. So I think one of the bigger parts of the bill that maybe, Matt, you could, I don't want to steal your thunder, but is the impact that this bill had. And you'll have to go back 3 or 4 years because something sunsetted which triggered this, but the R&D, research and development tax credit for contractors, we have a lot of them utilizing that. They do a lot of research and development. Things are getting even more complicated on how to build, how to design, how to construct. And so we had that. There was something that fell off like 4 years ago that made it really like a tax, like they increased everyone's taxes, but this bill came out and it's a huge windfall.
Yeah,
for taxpayers.
So to go into that, so with research and development expenses, the thing that fell off is you used to be able to, up until a few years ago, you could expense all of those research and development costs and take them against your taxable income.
So to clarify, for people who are listening, research and development is a wage credit.
Yeah.
So you go out there and if you're doing, and it's not just people in white coats, in a lab. There's a 5-part test, but a ton of construction qualifies it. Like every job is a little bit different. It's not like you get plans and they're perfect and you just go out and screw everything in together. Like that's not the way it works, right? You're on site, you're trying to figure out how to do it, how to build it, it's new to, like almost every job is new, and you're trying to identify it. You're working with some have design build, so they're actually designing how to do the project. All of that time can qualify. I'm speaking broadly here. All those wages can count, and you can get a percentage of them for a credit. And a credit's not like depreciation, which is a deduction. A credit is a dollar for dollar reduction in your tax liability.
Yeah.
So you pay $1 million in wages that qualify for R&D, you would get, $60,000 or so, whatever it is, I don't know the exact number.
Yeah.
Credit off your tax liability. Oh, wow. And you used to also be able to deduct the $1 million in wages.
Yeah.
So about 4 years ago, that changed.
Went away. They made it so you had to capitalize that wage expense like an asset, and then you had to break it up like a piece of equipment over 5 years. And so you weren't getting almost the double benefit of getting that credit for the research and development and the deduction. You were just getting the credit and then part of the deduction. In this bill, they restored the full expensing of research and development costs. And so it's really important, especially for construction contractors that may not realize that some of the stuff that they're doing qualifies as research and development, to take a look at, because the tax advantages because of the credit can be really advantageous for stuff that they're already doing.
Yeah, because when you say research and development, my brain instantly goes to some guy in a white coat with an engineering degree. Like, that's research and development. But if a guy's moving dirt and he's figuring out a new way to move dirt within his business using technology, as long as we're passing the 5-part test through that process, it has the potential to apply into something that they're just trying to improve their business and to go through it. Is that what I'm hearing? Am I hearing that correctly?
Pretty much. We see usually, like, from the project manager up, you start to see a lot of their time being allocated to that kind of design.
Okay.
Even in the company, there are things you can do internally in your company if you're trying to improve or do different things that can qualify. I mean, it is very, it's not just
Wide as
wide open or straightforward. There are companies out there that have people who understand the 5-part test, in details, and they'll do studies and they'll document it for you and do it right. It is something, um, it's like everything in the IRS. Like, it's a great credit to incentivize people to hire people to design things, to do things differently. Then there are people who take advantage of it. So now it's a little higher risk and you need to make sure you do it right. But the people especially in the construction industry, a lot of people are doing it. A lot of them are capturing it. And for the last 4 years, they've actually seen, because they're doing it, their taxes go up. So because it sunsetted in the original tax act. And so now it's come back. The immediate impact, 2025, will be for all these people that have spent 4 years capitalizing these expenses. They actually, for most of them, they get to take them all this year.
Yeah.
Oh, wow.
So you actually get, like 2025, I've been telling some of our clients, I'm going to take credit for this year. I mean, the last 4 years you've been yelling at me, but this year, like, you're going to make a lot of money and you're going to get this massive catch up deduction for that.
All right.
But then they made it permanent. So they doubled down on the fact that R&D is important to us. We want you to create, American jobs to help design and create things. And we're also going to make it permanent so that you can plan for this deduction going forward. You don't have to worry that it's going to sunset in 2 years or 4 years like it was prior. And R&D prior to this, it had to be renewed it felt like almost every year. So everyone's kind of wondering, hey, is this coming back? Can I plan for it? Now it's there, so we can do it. So
You zoom out and you look at the construction industry, it's prime for disruption. You've got a lot of competitors, a lot of work that needs to be done, and you also have a shortage of people coming in running machines, right? So constraints drive innovation. It's that simple. There's history that tells us anytime we have a constraint, innovation happens, and disruptors create some of that constraint and that innovation. So one of the things that happens a lot is like there's new technologies that customers can purchase and put on their machines that change the way they work. So could something like that potentially even qualify too, or is it just labor hours of people spending time doing stuff?
I would tell you that it's it's mostly a wage credit.
Yeah, which that's true.
Yeah. So when you buy other technology, a lot of times though, when you buy that technology, you have this in manufacturing too a lot. You buy this net technology, but how do you actually use it? How do you train? How do you get it installed? Where is it going to go? Right? Like in manufacturing, you think of it like they're trying to optimize their lines and stuff like that. They're trying to figure out where to move stuff. They're buying new equipment. They're maybe even custom building the equipment. So some of the wages going into that are there.
Yeah.
When you sign a contract with a customer, there's some rules.
Yeah.
Most of us won't fit those rules because we would never, like, one of the rules I think is the entire, like, it basically has to be an open-ended contract. The entire risk of loss has to be on you
Okay.
to take the credit. You're paying someone, you're taking the loss if
Yeah.
their design doesn't work out. And it doesn't have to work out to qualify. But if I sign a contract with a customer and I have like a fixed price and I don't have like this, then you start to get in it and might not qualify for the research and development.
Yeah, but I mean, look at all the time and energy it takes when somebody applies a new technology to the business of training, education, redoing their process layout, all the things that have to happen to make that work. Right. That's the hidden cost of technology, really. I mean, the purchasing of it, I'm going to buy a new manufacturing process or some new piece. That's usually the lowest piece of that. That's the lowest cost. It's all the other things that happen to apply it to the business to move forward and to make it work is some of that hidden cost that's still a huge benefit from an R&D perspective.
Yeah.
That's a massive win from there.
Yep.
So we've talked about the bonus depreciation. We've talked about our depreciation on both sides of that. We've talked about the qualified income extending out. We've talked about R&D that's out there. What else is in that big, beautiful bill that could potentially apply?
There's a lot of little stuff in there that can add up to bigger deductions. There's some credits on the individual side that when you're looking at pass-through entities, especially that could affect your owners of these businesses.
That was a big piece
The
because when they were negotiating this, that out of nowhere kind of got brought up as something that was going to be on the chopping block. And everyone started to freak out about that. And that really came in the original act, right? Because they have to balance, there's rules. They can't just, massively increase our deficit. So they still do it, but within the rules. One of the revenue raisers was your state and local tax and property taxes. If you notice on your individual returns, limited to 10 grand. I think they boosted that in the tax strip up to like 40 or something like that. But then all of a sudden the states, Idaho being one of them, got together and said, hey, we're going to take all the state income tax and we're going to call it a business expense. It used to be with an S corp or a partner, like all the flow throughs, it was the individual. Whoever owned it paid it on their side. They got together and said, hey, we're going to call this we found a loophole. The IRS looked at it and said, yep, nope, you're right. That works. And so all the businesses can elect to pay the state tax, which then gives them a federal deduction for it. Gives you 30% off your state tax.
Oh, there you go.
Right? Because usually in the past, people had not cared about that because they just put it on their individual return and get the deduction there. Well, they took it away. So now it's sitting inside all of our construction companies' businesses. They're paying the state tax. So through this big, beautiful bill, it all of a sudden became like, oh, we should cut that. We should fix that and not let them do it. And that would have been a huge impact. I mean, especially for some of the companies that are making a considerable amount of money, just Idaho alone is not a high tax state, but it's a 5.8% state tax.
Yeah.
There are some other states,
That are higher.
they're much higher, more than double. Yeah. So that makes it, and if you're a contractor and you're working across the country, which we have a lot here in the Valley that do, right, you're paying tax in all those states that you do work in. So it was definitely a huge win just to get it continued and to get it through. That definitely gave a lot of our contractors kind of holding that deduction.
Yep.
So
that was a big piece, a big win. The other thing I wanted to mention, just something that was in effect, that was made permanent for business owners when they have capital gains. The Opportunity Zone funds that were created under the Tax Cuts and Jobs Act that allow you to defer capital gain if you invest it in these what they determined as underdeveloped or underserved areas. And there's kind of a map that they come up with. And there's certain requirements, but if you meet all the requirements and reinvest that gain, so like if you sell stock or sell, real estate investments and stuff, and you have this big capital gain, you can reinvest it into one of these opportunity zones and defer that gain for a certain amount of time. And then it also comes up with some actual tax reduction. If you hold it in there long enough, you get an increase in the basis. So they extended that provision and made it permanent. And they identify new opportunity zones every so often.
That's pretty cool.
Yeah. And the other side too, on the tax bill, there are some not necessarily specific to contractors and dirt people, but they're all working for developers, right? Someone's usually bought the land, building something, developing something. So a lot of that, there were some tax advantages for them as well that also got pushed through. So hopefully that'll continue to spur, development and go through, because a lot of those tax codes got passed as well. And when we think about some of these, we say, oh, well, they just got extended, but like the pass-through deduction, right? Like you're looking at below 30%, or you would have started paying close to 40% if it had gone through the PTE, right? 30% of that. So, I mean, a lot of these things add up considerably for a lot of these contractors. So, yeah, even on the depreciation side, they upped the limits again too, and now they're finally set, I think, based on like
Indexed for
index
inflation.
later. So they'll continue to go up compared to the last 10 years. It's been, oh, here they are, and every year they're just going to go down.
Because inflation changed. Yeah.
Right.
Yeah.
So
Yeah.
Or they wanted to phase it out as part of revenue raisers in the first bill.
Right.
Well, so there's a lot of little benefits in there that you can somebody could deep dive and figure out how to take advantage of those from a lot of different perspectives.
Yeah.
That's totally awesome. Well, cool. Well, I appreciate your guys' time today. We've covered a ton of ground and a ton of details. So if a customer is listening or wants to get involved with you guys, how do they get involved with Sorren, and how do they reach out if they want to figure out how you can help their business?
So they can call either Matt or I directly. I mean, we're there, we're here. We have offices down in Boise and out here in Meridian. We're just down the road from you guys. We have probably close to 200 people here in the Valley. There's 17 partners. We have lots of great people that can help, depending on their specialty or whatnot, but we're always willing to help. People are, I don't know, sometimes nervous because they think, oh, I'm going to come into a tax person, and they get us confused with an IRS tax person. We're like, we're on your side. We're here to help you. Or they just, they don't know. And we have a lot of times we just help people. We just talk to them, pick up the phone, call them back. Like, they don't have to be ready to have all their tax stuff done by Sorren. Like, we are here just to help the community, to help people understand it. And then if we can find some ideas and help them out, then that's going to be awesome for us. So,
Well, I appreciate that. Thank you guys for joining. Much appreciated.
thank you.
Thanks for having us.
Yeah.